Welcome to 13th session of Management Accounting, 5th semester BBA, Bengaluru North University. In this session, we are going to solve some simple problems on capital structure ratios. In the previous session, we have discussed meaning, types, and their significance of capital structure ratios. The main objective of this chapter is to familiarize the students with the ratio analysis as a tool for financial analysis. The main outcome of this session is that the students will be able to compute the various ratios that test the long-term solvency of a business. See the problem. First problem. From the following balance sheet of X Limited as on 31st December 2016, calculate solvency ratios. Okay, the balance sheet is given here. With the help of this balance sheet, we need to calculate the solvency ratio. In this solvency ratio, it includes long-term solvency ratio and short-term solvency ratio. Now, under short-term solvency ratio, there are two ratios are there, current ratio and quick ratio. Current ratio, the formula is current assets divided by current liabilities. First, we need to calculate the current assets. In the balance sheet, there are three current assets, that is stock, debtors and loans and advances. If we add these three, we are getting current assets rupees 7 lakh. Next, current liabilities, it is given directly, that is 4 lakh. Now, current ratio is 7 lakh divided by 4 lakh means 1.75:1. Next, quick ratio. The formula for quick ratio is quick assets divided by quick liabilities. Quick assets, the formula is current assets minus stock. Current assets we have calculated 7 lakh and the stock it is given in the problem is 2 lakh. Now current assets is 5 lakh. Next, current liabilities is 4 lakh is there. This 4 lakh is also a quick liability because bank overdraft is not given. Now quick ratio is 5 lakh divided by 4 lakh is 1.25:1. Next, long-term solvency ratio. In that, the first one is debt equity ratio. The formula for this is long-term debt divided by shareholder fund. First, we need to calculate long-term debt. That is debenture plus cash paid. Only two long-term debt are given in the problem. Now, long-term debt is rupees 3 lakh. Next, shareholder fund. There are two shareholder fund items are given in the problem. One is equity share capital and another one is reserves and surplus. Now, shareholder fund is rupees 8 lakh. Debt equity ratio is equal to 3 lakh divided by 8 lakh, that is 0.375:1. Then proprietary ratio, the formula is shareholder fund divided by total asset. Shareholder fund already we have calculated, that is 8 lakh. Then total assets it is given in the problem 15 lakhs. If we substitute to the formula of proprietary ratio, we are getting proprietary ratio 0.53:1. One more long-term solvency ratio is there, that is capital gearing ratio. Formula for this is fixed income securities divided by equity shareholder fund. Fixed income securities is equal to, there are two fixed income securities are there, that is debentures and cash credit. So fixed income securities is rupees 3 lakh we will get. Next, equity shareholders fund. There are two items are there. One is equity share capital and reserves and surplus. If we add these two, we are getting rupees 8 lakh equity shareholder fund. Then capital gearing ratio is equal to 3 lakh divided by 8 lakh means 0.375:1 will come. Next, second problem. From the following balance sheet of X Limited as on 31st December 2009, we need to calculate current ratio, quick ratio, debt equity ratio and proprietary ratio. The balance sheet is given here. With the help of this, we have to calculate these ratios. Now first one we are going to calculate the current ratio. The formula is current assets divided by current liability. First we have to calculate the current asset. There are four current assets is given in the balance sheet, that is stock, debtors, investment and cash. If we add these four, we are getting current assets rupees 40,000. Then current liabilities, there are three current liabilities is given in the problem, that is creditors, bank overdraft and provision for tax. Add these three, we are getting 28,000. Now current ratio is equal to 40,000 divided by 28,000, that is 1.43:1. Then quick ratio. The formula for this is quick assets divided by quick liability. Then we need to calculate the quick assets. Quick assets is equal to current assets minus stock. Current assets already we have calculated, that is 40,000 and stock is rupees 12,000. Quick assets is rupees 28,000. Then quick liabilities, the formula is current liabilities minus bank overdraft. Current liability we have calculated 28,000. Bank overdraft that is given in the problem 4,000. Quick liabilities we are getting 24,000. Now quick ratio is equal to 28,000 divided by 24,000 is equal to 1.16:1. Next, debt equity ratio. The formula is long-term debt divided by shareholder fund. Long-term debt, only one item that is given, that is 5% mortgage loan, that is 32,000. Then shareholder fund, there are three items are given for shareholder fund, that is equity share capital, capital reserve and profit and loss account. If we add these three, we are getting 60,000. So debt equity ratio is 0.53:1. Next, proprietary ratio. The formula is shareholder fund divided by total asset. Shareholder fund already we have calculated 60,000. Then total asset it is given in the problem. Now proprietary ratio is equal to 60,000 divided by 1,20,000. That is proprietary ratio is 0.5:1. Now problem number 3. If profit after interest and tax is rupees 25,000, interest charged is rupees 5,000, provision for tax is rupees uh, 10,000, find interest coverage ratio. So formula for interest coverage ratio is earnings before interest and tax divided by total interest. So here in the problem after interest and tax is given, but we need before interest and tax. So for that what we have to do, we have to take profit after interest and tax. For that we need to add interest plus tax. So EBIT, that is earnings before interest and tax, we are getting 40,000. That is 25,000 plus 5,000 plus 10,000. Now interest coverage ratio is 40,000 divided by total interest paid is 5,000. 8:1 is the interest coverage ratio. Next, problem number 4. Calculate debt equity ratio and interest coverage ratio from the following. Here equity share capital given, preference share capital is given, general reserve, preliminary expenses, net profit before interest and tax, interest, debentures, loan and tax is given in the problem. Now debt equity ratio, the formula is long term debt divided by shareholder fund. Shareholder fund we need to calculate with the help of given information, that is equity share capital plus preference share capital plus general reserve, and then we need to deduct preliminary expenses. So shareholder fund we are getting 27,36,000. Then long-term debt. There are two long-term debt that is given in the problem, debenture and loan. So long-term debt we are getting 9 lakh. Now debt equity ratio is equal to 9 lakh divided by 27 lakh 36,000, that is 0.32 is to 1. Next, interest coverage ratio. Here the formula is EBIT divided by total interest. EBIT, that is given in the problem, 3 lakh, and total interest is also given in the problem, 60,000. So interest coverage ratio is 5 is to 1. Then multiple choice questions. The first question is quick assets is equal to current assets minus. The options available are stock, current liabilities, quick assets and quick liability. The correct answer is stock. Second question. Dash is equal to fixed income securities divided by equity shareholder fund. And the options are quick ratio, current ratio, debt equity ratio, capital gearing ratio. The correct answer is capital gearing ratio. Next, third one. Proprietary ratio is equal to shareholder fund divided by dash. The options available are liquid liabilities, current liabilities, total assets, total liabilities. The correct answer is total assets. Then fourth one. Interest coverage ratio is equal to earnings before interest and tax divided by dash. Options available are total expenses, total income, total tax and total interest. The correct answer is total interest. And the last multiple choice question is dash is equal to long-term debt divided by shareholder fund. Options available are current ratio, acid test ratio, proprietary ratio and debt equity ratio. The correct answer for this is debt equity ratio. So these are the books for reference. Thank you.